Every year in America, millions of people have the same argument. Your coworker swears real estate is the only real path to wealth. Your other friend says the stock market is all you need. Someone's uncle at Thanksgiving is convinced rental properties are how you retire early. Your financial advisor is pushing index funds. The personal finance internet is split down the middle, and both sides sound completely certain. They're both leaving out the part that changes everything. Because when you actually run the full numbers, every dollar, every hidden cost, every hour of time over 20 years, the answer isn't what either side is telling you. And the gap between what people think these investments return and what they actually do return is large enough to change your retirement date by a decade. Today we're breaking down investment math. This is your first time here, subscribe now. We do this kind of real number breakdown, and this one might be the most important video on this channel. Today we're going to run the complete, honest comparison. Real estate versus index funds. Same starting money, same city, same time frame, 20 years. No cherry picking, no YouTube thumbnail math. The whole picture. One of them forgot to count the hours. The other forgot to count the zeros. When you include both, the result will surprise you. Meet Chris and Alex. Both 32 years old, both living in Columbus, Ohio, a solid mid-market American city that's representative of how real estate performs across most of the country. Both earning $58,000 a year. Both have $50,000 saved. Same starting point in every measurable way. The only difference is what they do with that $50,000. Chris uses it as a 20% down payment on a $250,000 rental property, a modest 3-bedroom house in a decent neighborhood. He takes out a 30-year mortgage at 7%, the national average for investment property loans in 2024. His monthly mortgage payment is about $1,330. He finds a tenant willing to pay $1,800 a month in rent. On paper, that's $470 a month in profit before Chris has spent a single dollar on anything else. Chris feels like a genius. Alex takes the same $50,000 and puts it into a total stock market index fund, a fund that tracks the entire U.S. market, roughly 3,700 companies, with an expense ratio of 0.03%. He sets up an automatic contribution of $300 a month and doesn't think about it again. His coworkers ask what he's investing in. He says, index funds. They nod and change the subject. Nobody's impressed. Day 1, Chris has a house, a tenant, and a story to tell at dinner parties. Alex has a brokerage account and a confirmation email. It's not close in terms of how it feels, but feelings and math are two very different things. For the first few years, Chris is living the landlord dream. Rent checks hit his account on the first of every month. He drives past the property on the way to work and thinks, I own that. He's claiming mortgage interest and depreciation on his taxes, shaving a few thousand off his annual bill. He's building equity with every mortgage payment. He's watching comparable homes in the neighborhood tick upward. Alex logs into his brokerage account once a quarter. The number goes up a little, then down a little, and up a little more. Year 1, his $50,000 grows to about $55,000. Year 2, around $61,000. It doesn't feel like anything is happening. There's no key in his pocket, no tenant texting him, no asset he can point to from his car window, just a number on a screen. Chris's friends ask him about the property. Alex's friends don't ask him about anything. The social proof alone makes Chris feel like he's winning by a mile. Now let's run the actual numbers through year 3 because this is where the landlord math first starts to break down. Gross rent, 36 months times $1,800, $64,800. Mortgage payments, 36 times $1,330, minus $47,880. Gross cash flow, $16,920. Property taxes, $3,000 times 3 years, minus $9,000. Insurance, $1,500 times 3 years, minus $4,500. Water heater replacement, minus $1,200. Roof repair, minus $2,800. Vacancy, 1 month lost rent plus cleanup, minus $2,400. Actual 3-year net cash flow, minus $2,980. Chris's actual net cash flow through year 3, negative $2,980. Not the $16,920 that looks so good on a napkin. He's slightly in the red, and we haven't counted a single hour of his time. Not the 10 p.m. phone calls from his tenant, not the Saturday morning he spent coordinating the roof repair, not the 2 weekends he spent showing the unit when his first tenant left. We'll come back to what those hours actually cost. Alex, meanwhile, has contributed $50,000 plus $10,800 in monthly contributions. At roughly 10% annual average return, the S&P 500's historical nominal average, his portfolio is sitting at approximately $78,000. He spent 0 hours managing it. Chris still has leverage working in his favor. His $250,000 property has appreciated roughly 3.5% per year, the national average per FHFA data, and is now worth $277,000. His equity has grown to approximately $62,000. That's real wealth, and it came partly from using the bank's money. That leverage advantage is real, and we're going to give it full credit. Here's what landlord content never shows you. The $470 monthly cash flow figure, the number on the thumbnail, the number at the real estate meetup, the number your buddy brags about at the cookout, is a gross number. What you actually keep is completely different. Let me walk through every cost category that eats into it. Number 1, vacancy. The average rental property in the United States sits vacant approximately 7% of the time, roughly 25 days per year, or about 1 month. That's not a disaster, but it's a full mortgage payment with zero income to cover it. And during that vacant month, you're also paying for cleaning, minor repairs, listing fees, and your own time to screen and show the unit. Number 2, maintenance and repairs. The standard rule used by real estate financial planners and the National Association of Realtors is to budget 1 to 2% of the property's value annually. On a $250,000 house, that's $2,500 to $5,000 every year. Some years it's a $200 faucet fix. Other years it's a $7,000 HVAC replacement you didn't see coming that you can't postpone because it's August and your tenant is threatening to leave. Number 3, capital expenditures. Roofs last 20 to 25 years. Furnaces last 15 to 20. Water heaters last 10 to 12. Appliances, 10 to 15. These are guaranteed future costs, and they arrive in chunks of $5,000 to $15,000. If you're not setting aside money every month for these replacements, you're not running a business, you're running on luck. Number 4, property management or your own labor. If Chris hires a property manager, that's 8 to 10% of monthly rent gone immediately, about $150 to $180 a month. If he manages himself to save money, he's working a part-time job he's not getting paid for. Either way, it costs something. We'll show you exactly how much in dollars. Number 5, bad tenants, the risk nobody wants to calculate. A tenant who stops paying and understands the eviction process can cost 3 to 6 months of lost rent plus legal fees averaging $3,000 to $7,000. In states with extended eviction timelines, California, New York, Illinois, the exposure is even higher. That single event can erase an entire year's profit. It doesn't appear in any cash flow calculation until it happens to you. The opening line of this video promised to count the hours. Here's the count. Over 20 years of managing a single rental property, a conservative estimate of Chris's time investment breaks down like this. Tenant screening and showings, 4 turnovers times 15 hours, 60 hours. Repair coordination and contractor oversight, 120 hours. 10 p.m. phone calls, monthly admin and record keeping, 240 hours. Major renovation oversight, 1 renovation, 40 hours. Annual tax prep, insurance review, bookkeeping, 80 hours. Conservative 20-year total, 540 hours. At Chris's equivalent hourly rate based on his $58,000 salary, approximately $27.88 per hour, those 540 hours represent $15,055 in unlisted labor cost. At a professional property manager's billing rate of $35 an hour, it's $18,900. Most real estate cash flow calculations never include this number. It is always there. It just hides in your weekends and your evenings and the mental load of being responsible for someone else's home. Chris's true 20-year cost includes roughly $15,000 to $19,000 in personal labor that never shows up in any landlord spreadsheet. By year 5, Chris is deep in the reality of being a landlord. He's on his 3rd tenant. He's replaced the roof for $8,500, dealt with a plumbing emergency that cost $1,400, and absorbed 1 month of vacancy between tenants. He's raised rent to $1,950, which helps, but his property taxes and insurance have both increased. His cash-on-cash return, the money he actually pockets relative to the money he put in, is running about 3 to 5% after all real expenses. Not terrible, but not the 15 to 20% he mentioned at the barbecue. Alex is still doing absolutely nothing. His portfolio is approaching $140,000 by year 7. The gains on his gains are now generating more new wealth each year than his original contributions. Compounding is boring for the first 5 years and astonishing for the next 15. Now let's stop at year 10 and take a full accounting of both positions. Chris, year 10. Property value, $250,000 at 3.5% per year times 10 years, is just under $353,000. Remaining mortgage balance is just under $166,000. Equity, just under $187,000. Total out-of-pocket beyond down payment, taxes, insurance, repairs, capital expenditures, vacancy, is just over $28,000 to $40,000. Labor cost, approximately 270 hours times $28 an hour, is just under $7,560. Alex, year 10. Initial $50,000 at 10% for 10 years is just under $129,685. $3,600 a year at 10% for 10 years is $57,375. Total portfolio value is just under $187,000. Total contributed, down plus monthly, is $86,000. Total labor hours, 0. At year 10, they're nearly identical in total wealth. Chris at about $187,000 in equity, Alex at about $187,000 in portfolio value. But Chris also spent $28,000 to $40,000 extra in costs and 270 hours of his life getting there. This is where the story separates, because from year 10 onward, compounding accelerates exponentially for Alex, while Chris's returns remain largely linear and dependent on continued labor. By year 20, here's where both men actually stand. Chris, year 20. Property value, $250,000 at 3.5% per year times 20 years, is just over $497,000. Remaining mortgage balance nearly paid off, $40,000 to $60,000. Gross equity, $437,000 to $457,000. Total extra costs over 20 years beyond down payment, taxes, insurance, repairs, capital expenditures, vacancy, one major renovation, is just over $65,000 to $90,000. Total labor cost, 540 hours times $28 an hour, is just over $15,000. Net equity after all costs, $362,000 to $392,000. Total cash flow profit 20 years net of all costs, $40,000 to $65,000. True net wealth created, $402,000 to $457,000. Alex, year 20. Initial $50,000 times 1.10 to the power of 20 is $336,375. $3,600 a year times 1.10 to the power of 20 minus 1 divided by 0.10 is $206,190. Total portfolio value is just over $542,000. Total contributed, down plus monthly, is $122,000. Pure compound growth over $420,000. Total labor hours, 0. Debt carried, 0. Alex, $542,000. No debt, no tenants, no 2 a.m. emergency calls, 0 hours of labor. Chris, $402,000 to $457,000 in true net wealth, after 540 hours of labor and 20 years of concentrated single asset risk. When you add the $200 per month increase to Alex's contributions, bringing him to $500 per month, a realistic adjustment as his income grows over 20 years, his portfolio jumps to approximately $720,000 to $750,000. That's the compounding multiplier effect of increasing stock contributions that simply doesn't exist in real estate without buying a second property and doubling the workload. Chris worked for his wealth. Alex waited for his. And in this specific comparison, waiting paid more, with less risk and 0 hours spent. If I only showed you the downsides of real estate, I'd be doing what every stock market influencer does. So let's be honest, stocks have real, serious risks that index fund advocates love to gloss over. Number 1, volatility is brutal and most investors can't handle it. In 2008, the S&P 500 dropped 37%. In March 2020, it fell 34% in 5 weeks. If Alex had $150,000 in his portfolio and watched it become $95,000 in a matter of weeks, that is not a number on a screen. That is viscerally gut-wrenching. And the data is unambiguous. Most retail investors panic sell during crashes and buy back in after the recovery, locking in losses at the worst possible time. Number 2, no cash flow. Real estate sends you a check every month, even an imperfect check after expenses. Index funds don't. Total market fund dividends run about 1.5 to 2% annually. On $150,000, that's roughly $200 a month. That is not replacing anyone's income or covering anyone's mortgage. Number 3, the leverage advantage is real. Chris used $50,000 to control $250,000 in assets, a 5-to-1 leverage ratio that doesn't exist in public market investing without margin risk. That leverage is the primary reason real estate has created generational wealth for American families. It's also the reason a market correction can briefly put you underwater on a $250,000 property you only put $50,000 into. Leverage amplifies both gains and losses. Number 4, the tax advantages are genuinely powerful, with caveats. Depreciation allows real estate investors to deduct the theoretical decline in a building's value from taxable income, even when the property is actually appreciating. On a $250,000 property with $50,000 allocated to land, the depreciable basis is $200,000. Over 27.5 years, that's roughly $7,273 annually in paper losses. At a 22% tax bracket, that's approximately $1,600 per year in tax savings over 20 years. $32,000 in cumulative tax benefit that stock investors simply don't have access to. Important caveat: passive activity loss rules under IRS Publication 925 limit this deduction for most salaried employees. If your income exceeds $150,000, the depreciation deduction phases out entirely unless you qualify as a real estate professional under IRS guidelines. Know your situation before modeling these numbers. Number 5, real estate wins in specific scenarios. If you're in a market where monthly rent is at least 0.8 to 1% of purchase price, what's called the 1% rule, the cash flow math works in your favor from day one. Columbus, Ohio qualifies. Los Angeles does not. If you're house hacking, living in one unit of a duplex or triplex and renting the others, you can reduce your own housing costs to near zero while building equity. That's a return profile the stock market literally cannot replicate. If you're a business owner who can legitimately deduct vehicle use, home office, and travel related to your properties, the tax math shifts dramatically in real estate's favor. And if you understand 1031 exchanges, rolling profits from one property into the next to defer capital gains taxes indefinitely, you can build a real estate portfolio in a way stock investors can't match inside taxable accounts. Here's the honest framework for making this decision for your own situation. Choose index funds if you value time and simplicity above all else. If you have no interest in being a landlord, if your market doesn't support the 1% rule, if you're not willing to treat rental property as a second job, stocks will produce comparable 20-year wealth with 0 hours of labor and full liquidity. Choose real estate if you're in a strong rental market, you're genuinely willing to manage it as a business, you understand every cost category before you close, and you're using leverage deliberately rather than accidentally. In this scenario, especially with multiple properties, your returns can significantly exceed index funds. Choose both if you can. The data on combined portfolios is compelling. Index funds provide liquidity and passive compounding. Real estate provides leverage, tax shelter, and cash flow diversification. The people who retire early in America, at 45 or 50 rather than 65, are overwhelmingly using both simultaneously, not choosing sides in an internet argument. Real estate isn't a better investment than stocks. Stocks aren't a better investment than real estate. The better investment is the one you will actually execute correctly for 20 years. Chris and Alex both made reasonable decisions with the same $50,000. Chris thought real estate was the proven path to American wealth. Alex thought the market would quietly do the work. Neither of them sat down and mapped out what their choice would cost, in dollars, in time, in stress, and in risk, over 20 full years. The real trap isn't real estate. It isn't stocks. The real trap is picking either one based on a YouTube thumbnail, a podcast clip, or something your uncle said at Thanksgiving, without ever running the complete numbers for your specific situation, your specific market, and your specific capacity to manage the investment correctly. The answer that includes everything is the only answer that matters. If this broke down something you've been trying to figure out, drop a comment. I read every one. Like the video if the math helped. Subscribe if you want more of this. Real numbers, no hype, no sides to pick. See you in the next one.